Good morning, everybody. We have an agenda today which is relatively long. The good news is I have lots of slides, so I hope we'll keep that entertaining. A few of those slides have maybe more details than are comfortable to see from the back of the room. I apologize for this in advance. You will find them on the website or in the handouts. I hope I'll be able to give you color as to those slides. We'll start with the big picture, and the big picture is quite simple. Never in the history of man has so much money been thrown at any problem. We did have an enormous problem. If we listen to Mr. Bernanke yesterday, officially it's over, or on the right way. What is certain is, yes, to some extent it seems to be showing some results, and unsurprisingly, those results are showing in emerging economies first, essentially for two reasons. The first one being that, well, it's fair to say that emerging economies didn't share in the structural problems and structural issues that plagued the rich world and triggered the crisis in the first place. Secondly, also because emerging economies, once more, as happened many times in the past, appear to be playing their role as a warrant on global growth, and therefore are rebounding pretty handsomely in the process. The point about not sharing in the same difficulties or same problems, same structural issues as rich countries have, is a partial one. And indeed, when the whole crisis began to break out in slow motion, initially, that was 2 years ago, the officials we deal with fairly regularly around the Asia-Pacific region, in some cases, to my taste, were maybe a little bit too smug about it. You know, oh, those crazy Americans with their mortgages, that's not our problem. Well, they happen to be buying your goods, so it will quickly become your problem, and that's exactly what happened. But now we're told the rebound is here. Well, even with new and updated and improved forecasts coming, in this case, from the IMF, but coming also from all sorts of private economists, the reality is that in the rich world, the rebound is not going to be a very exciting one, neither this year nor next year, and that if it's really growth we're looking for, that's likely to happen in emerging markets and pretty much not elsewhere. And indeed, in emerging markets, if we're really looking for high growth, it seems that Asia appears to be the only play in town. So that's the big picture. If we focus a little bit on the Asian picture, we have things that are perennial, we have things that are structural that are happening, and we have things that are a bit more short-term in nature. The structural, the not very new to, in some sense, Asian story is still very much in place. The point about Asian economies having low debt, low budget deficits, high savings rates, a strong focus on growth, there's nothing new there. What is new is that compared to the rest of the world, they look prettier in those respects than they ever did before. The point about having undervalued currencies is something which is not new to some extent, maybe more true today than it was before, certainly before the crisis. Maybe the points that are linked to the aftermath of this crisis are really the fact that there was a huge question mark on China, and China appears to have delivered in terms of growth and indeed managed its growth. Expected returns, comparative returns on other assets, be they cash, fixed income, equities in the rich world, appear to be rather unappetizing from where they are. And generally speaking, we have global indicators that appear to be turning, and historically that always was a big source of boost for returns in emerging markets and in Asia. So this is all fine and well, but you're all experienced investors in this room. You know that when a fund manager is talking about the structural story, you can sense something is off, and this is what it is. It's not cheap. The situation that we had earlier this year, where arguably Asian equities were screaming by because they were at extremely depressed levels, even though the structural story was intact, that situation is firmly behind us. We are looking now at markets that are, by any measure, not cheap. Not enormously overvalued. We're not in bubble territory, but this is not cheap. And what we are seeing right now in the debates we have with our customers, with our investors, and indeed what we are reading in the press and in some of the research that's being published, is a bit of an opposition of views between the ones who are focusing on valuation, and indeed we do believe valuations matter, and the ones who are focusing on the tailwinds that are propelling emerging equity markets, and particularly Asian markets. And indeed, those tailwinds are very powerful. We've seen recently the ISM turn the corner, go back above 50. In recent history, each time the ISM went back over 50 after a recession, there was a long and significant period of outperformance in emerging markets, and particularly Asian markets. Secondly, liquidity is plentiful, and there is absolutely no doubt that a lot of this liquidity is finding its way to Asian markets, as is shown by this chart. And maybe slightly more worryingly, the locals are buying their own product, and even including the retail investors, and that's something which is interesting. Retail investors around Asia have always been a very important feature of turnover on the stock market. However, for the previous 10 years almost, they were more or less in secular decline. The two examples we're showing here are Korea and Taiwan, where historically retail investors are very important. In Korea, it was even the case at one stage that retail investors were the number one driving force on the options market. And you can see this very significant uptick in the recent past. This has something to do with the fact that other assets, other returns appear unappetizing. HSBC in Hong Kong will very generously pay you 0.001% on your deposits, and that's why liquidity is plentiful, and that's true across the region. And so what we have here is retail investors who are seeing stocks that probably are no longer cheap, but are yielding on average 2%. That's a lot more than any deposit they can get anywhere in Asia. So what do? We try to focus on relative value, and indeed looking around the region, there are places where we are happy to be overweight and to be invested. Generally speaking, in global portfolios, and particularly in global emerging market portfolios, we are overweight in Asia, because indeed other emerging markets generally have, not all of them, but quite a few of them have structural issues that Asian markets don't have. And within Asia, we are comfortable overweighting places like China and Indonesia, for instance. Whereas on the other hand, there are places like Taiwan, which definitely appear to be stretched, or places like India, where we're a little bit agnostic as to where the market is heading from now. What this tug of war between valuations, which again do matter, and those very powerful tailwinds lead us to believe is that we're probably headed for a period of sideways markets, where, quite simply, prices have to catch up with the fundamentals. Prices have to catch up with earnings expectations. Earnings expectations today have turned spectacularly across Asia for the better, but right now there are expectations. We need to see a couple of earnings seasons before we can be firm there. What also is very impressive for us around the region is that 70% of our asset management business around the region is institutional. A very large share of that is with investors such as yourselves or insurance companies who hold a lot of cash. Maybe not in this country, but certainly north of this country, hold a lot of cash. And the question I've had the most often in the last 6 months is, when do you expect a consolidation? Subtext being, so that I can get back in. In terms of strategy, so relative value, definitely. What we do with the rest of our portfolio is really, in terms of theme, there is a very powerful theme that we're looking at, which is consumption-driven growth, and I'll come back to that. This is a very, very key theme for governments around the region who have a very simple and very strong understanding that a purely export-driven growth model is one that's unlikely to be sustainable for the long term, with good reason, I believe. And other than that, maybe the rest could be characterized as what could be called, quite simply, a value strategy, which maybe 10 years ago in Asia was a bit of an oxymoron. It's no longer the case. We do have serious improvements in the quality of the balance sheets, in some cases even the quality of the governance, dividend payouts that allow us to implement that. Another thing that would be tempted, or that is tempting actually in the current environment, is small cap strategy. But this is something that, first of all, has already delivered extraordinary returns this year. And secondly, this is not something that's worth considering on a tactical basis. Transaction costs in and out are just too high. Certainly a space to have an interest into, but not on a tactical basis. I'll focus for a moment on China because China is just too important for the region. There's a saying in Latin America that Brazil is half of everything in Latin America, while in Asia, China is a bit more than half of everything, really. And indeed, they've been very, very successful at managing their growth. We do, as everybody else, take Chinese figures with a pinch of salt, and every now and then with a shovel of salt. That being said, the dynamics are there, the results are there, and I won't bore you with the figures, but maybe the key point to note here is that this crisis is actually a golden opportunity for Chinese companies and for the Chinese government. The renminbi is the only currency that's been stable throughout the whole crisis. Amazingly, it has shown less volatility during the crisis than before. And we know that very well. This is for them a golden opportunity to buy companies, to buy resources, and to gain acceptance in doing so. Not 100% of the time, but to gain acceptance in doing so better than ever before. Short term, it also puts a bit of a dent in the secular case for a more expensive, a higher renminbi rate. 2 years ago, that case was easy to frame in terms of Chinese national interest. If you're buying commodities the world over, whose prices are going up very quickly and who are produced in countries whose currencies are going up very quickly, you want to have a stronger currency. You want your currency to appreciate, especially if your price advantage in terms of your own exports is so big that it's unlikely to be dented by an appreciating currency. Fast forward to today, the price of those commodities has tumbled, the price of those currencies has fallen, rebounded a bit, but not to the full extent. And very importantly, the price of the currencies of all your competitors has fallen down so that this price advantage that Chinese goods enjoy has been somewhat eroded. So short term, the case for a far stronger renminbi, I think, is a little bit weak. Long term, the structural arguments apply and will work. And long term, there's one thing which is important to bear in mind, is that the domestic sector is actually extremely important to China. That's the big difference between China and Korea, for instance. When you're looking at Korean exports, you're looking at mostly domestic value added. You're looking at something which is almost 100% homegrown. When you're looking at Chinese exports, you're looking at something which is mostly re-exports after local assembly. So the domestic sector is already extremely important for the Chinese economy. What needs to be strengthened, what needs to be pushed, is household consumption. And the stimulus package that's been put in place earlier this year in an indirect way, and I think in a very clever way, is aiming straightly for this. What is this about? This is about building infrastructure to strengthen the competitivity of this economy. Just to give you an image, there's about as many kilometers of railways in China as there are in the United Kingdom. Admittedly with a few more people and kilometers to cover, however. So this is not a Japanese strategy for stimulus of the economy. Those are not bridges to nowhere. Those are bridges and railways that are actually needed. There's a subtext in here also, and that's the healthcare and education, the rural infrastructure, the low-income housing part of this, which is about trying to push a little bit those Chinese citizens maybe to save a little bit less. Savings rate in China for somebody, especially in the low and medium income brackets, the saving rate is 50% and more. Education, healthcare, pension, all of this is deficient or non-existent. There is no safety net, really. So the savings rates are very, very high. And obviously, if you want to push domestic consumption, you need the savings rate needs to go down. By the way, there's a big fourth reason for the savings rate to be high, which is to pay for the kids' wedding. So there's a subtext there. But obviously, this is not like driving a car. It takes years and years. Also, this is a fairly headline-grabbing figure. It's 4 trillion renminbi. On paper, that's about 14% of GDP. Absolutely huge. The reality, if you discount decisions that were made already, things that would have happened otherwise, is that you're probably down to 10% of GDP. Well, that's already more than 12 months of growth. And what this doesn't include is something which, in an indirect way, is reflected on this chart, is bank lending. There's been a lot of press about this increase in bank lending in China recently, and this press usually focused on the very far end right side of this bank lending. And what this shows, indeed, as was reported in the press, is year-on-year increase in bank lending in the vicinity of 50%, which obviously raises a few eyebrows and a few worries. This is in the context, as is shown by this graph, of a secular fundamental shift in the Chinese financial sector, which essentially has been shored up in the past 10 years. And there's a strong element of luck in this. Had this financial crisis struck 5 or 7 years ago, the Chinese financial sectors would not have been able to cope. The Chinese government has spent, your guess is as good as mine, probably something in the vicinity of $300 billion in the last 10 years, recapitalizing the banks, hiving off the non-performing loans. Interestingly, they were put in companies that were created specifically for that were called asset management companies. 5 or 7 years ago, if you were in China and saying, I work for an asset management company, they would say, oh, okay, so you're a debt collector, right? That's gone now, that's gone into workout. So the reality is that this banking sector is actually extremely strong, has a very strong balance sheet. The reality also is that the bulk of those loans are done to municipalities, regions, who are building their own infrastructure. To give you an example, there are 17 mid-sized cities. A mid-sized city in China is 5 to 10 million people, who have finally been granted permission to build their tramway or railway or subway that they've been asking for several years. Most of those projects are things that had been cooking for several years, and to whom the central government was saying until the middle of last year, no way, we have enough inflation, we have enough demand for resources, we can't cope, you'll wait. These people have been told, go ahead and get financing from the bank. And the bank was told, you lend. That's the benefit of a command economy, I guess. But the reality is that those are loans that are made to entities that most likely will repay their loans, and if they show no willingness to do so, will be arm twisted into doing it. Obviously, with such a cocktail, the rebounding growth has been spectacular. No need to explain this much further. And this is in a context where household consumption and household income, before we talk about consumption, keeps growing fast. And this chart is in nominal terms. I insist on this because you might say, well, hang on a minute, first half of 2009, the rate of growth is far smaller than 2008. Yes, but in 2008, there was 6% inflation. There is no inflation in 2009, so in real terms, it's not that different. You can see the discrepancy over the years between rural and urban. That's directly the consequence of policies that work more or less well, but clearly rural infrastructure and therefore rural incomes are something that are very much looked at in Beijing. And the result of all of this, in a context where we're talking about a household sector which has no debt and lots of deposits, is a lot of consumption, a lot of shopping. And really the saying is, well, usually people say the US catches a sneeze and the rest of the world is coughing. No, well, China goes shopping, sorry. Where that leads us in terms of equities, and that's something which is the perennial bugbear in Asia. The growth story is great. The equity returns have not always been great, far from it in some cases. In the case of China, first of all, when we talk about Chinese equities, in most cases, people have a focus on what they are allowed to buy, what they can buy, which is in Hong Kong, H shares and red chips. That's 242 companies. That's about $1 trillion in market cap. The real thing is on the other side of the border. A shares, about 1,600 companies, about $3.5 trillion in market cap. And as you can see, just by the number of companies, very little overlap between this and Hong Kong listed companies. Obviously, getting in and out of China A shares is difficult. You need a QFII program. The amount of QFII programs that have been granted to investors is only $30 billion. So you can see that compared to the market cap, it's a drop in the ocean. But that, we believe, is where the real game is, provided you can do a lot of research on the ground, because governance in China does matter. Kicking the tires, going around the warehouse, counting the trucks does matter. In terms of valuation, China is probably the one country in the region where we have actually seen the earnings beginning to come through, and actually it was an interesting period in August where we had an absolutely appalling month. Prices were down 20%. And at the same time, it was earnings reporting season, and it was the best earnings reporting season we had seen in China compared to expectations for a long time. And that means that valuations there, and here we're focusing on H shares for those graphs, valuation there are probably more attractive, certainly more attractive than they are in many other parts of the region. I'll spend a couple of minutes to talk about Asian fixed income. Asian fixed income is an asset class which is generally completely overlooked. Historically, for good reason, it was tiny, it still is small. However, it is a rather interesting, rather good in risk-reward ratio terms, access to the Asian growth story, a low volatility access to the Asian growth story. In terms of size, you're looking at something like $2 trillion covering the entire region, half and half in local currency and dollars, and roughly half and half in corporate and state issuance. The downside to this asset class is that government issuance tends to be reasonably low yield. You have countries like Hong Kong, Singapore, Taiwan, where the yields are indeed very, very low. However, the upside to this story is that if you can do the research, if you can pick investment-grade corporates around the region, we still have spreads that are fairly interesting, fairly meaty, and indeed better than what you would find for similar quality paper in the United States, for instance. We don't really do high yield in this region, or when we do high yield, it's sovereign high yield, like Indonesia, for instance, would qualify as high yield, and given its rating, and this is not something that we worry about in terms of ability to repay its debts. But Asian investment grade is certainly a space to watch and an interesting source of diversification. Looking around Asia, the other thing that we should talk about is private equity. My one-liner on this for now would be, well, extremely interesting space, but right now don't hold your breath. What I mean by this is there's been a lot of money raised in Asian private equity, mostly before the crisis in 2007 and early 2008, including by ourselves. And I'm actually quite happy to say that our latest private equity fund, as of today, which closed in June 2008, that fund as of today is only 18% invested. In other words, we didn't try to catch a falling knife. What this means, however, is that there won't be much action for you in there because we are going to be busy for the remainder of this year and most of the next year putting this money to work. And we know we're in good company. We know most of our competitors are in the same situation. But nonetheless, interesting space to watch. And maybe just one more word on this, which is private equity in Asia is not at all the same game as the one which is being played in Europe. Doing deals takes a lot more time. A good private equity deal in China can take up to 18 months from pipeline to execution. Best case scenario would be Korean private equity deals, which are typically 6 months. And also, in many cases, the role we're playing is we're not taking companies private. They're already private. Our role as private equity investors, I think the best analogy I can use is we are midwives. We're helping those companies to become institutionalized and to be sellable via a trade sale or an IPO. And the trade sale is actually, in many cases, the preferred exit strategy because those companies are generally small and medium-sized, and they are far more valuable for somebody who is doing horizontal integration, for somebody who is getting a foothold into Asia, than they are. They're more valuable to these people than they are for minority shareholders like you and me. There are a few figures. You'll get that in the handouts later. I'm not going to go through this, but basically, very interesting space. Not right now. Don't hold your breath. Real estate is something we do particularly in China, and from that you'd be forgiven if you deduct from this that we like difficulty. To put it very simply, it's a high-risk, high-return business. Very interesting, where I would say that the two key words are, number one, partnership, find the real partners, and even HSBC, with 150 years of presence in China, has felt the need to go into partnerships to do real estate deals there. And the other key words there are, well, make sure that those partners are institutional grade, institutional quality, and willing to put as much equity up front as you are. If not, walk away. Very interesting business. Difficult work, hard work, very, very interesting business, and lots of opportunities. I think the summary here is, number one, the fundamentals, the Asian fundamentals are good, the valuations are not. There are pockets of interest, clearly there are, and those pockets of interest are all the more interesting, especially if you're an active investor doing a lot of bottom-up research. The fundamentals are good. I would argue even that they're better than they used to be, simply because, number one, there are lots of variables, macroeconomic variables, that have improved over time. And you might say in that sense that the Asian crisis more than 10 years ago, a few lessons were learned out of this. But also the fundamentals are good relative to the rest of the world, where in many places they are indeed very bad. In this sense, ignoring Asia, I think, would be the mistake. But don't rush headlong. There are many pitfalls, and valuations do matter.